American consumer is showing some signs of stress. Credit card delinquencies are near a 5-year high, and higher earners are under more pressure. Sharon Epperson joins us right now with the CNBC exclusive report. And Sharon, this is kind of counter to what we've heard from most of the big banks recently.
Absolutely. You know, borrowers are having a lot of trouble increasingly paying their bills on time, and delinquencies are near their highest level in 5 years as consumers have fallen behind on auto loan, credit card, mortgage and personal loan payments last year. That's according to a new VantageScore report. For higher earners, people earning more than $150,000 a year, the delinquency rate has more than doubled since January 2023. We spoke exclusively to VantageScore CEO Silvio Tavares, and he explains why.
And we've seen significant increases in services costs like home insurance, like auto insurance. And that is hitting the high-income consumer harder than most, and that's what's driving that delinquency rate.
Overall, Tavares says consumers are being cautious with credit. While credit card balances are about 2.9% higher than a year ago, that's still in line with the rise in inflation. And consumers aren't at their limit.
Credit utilization actually decreased on a year-over-year basis. It was actually down about a full percentage point to about 51.6% credit utilization. 100% credit utilization would have mean the consumer is maxed out, but they weren't. They actually had a lot of available credit. They just chose not to use it.
And that, Tavares says, is a positive sign that consumers are exercising self-control and are more credit cautious as we start the year. You know, despite last year's strong stock market gains, concerns about inflation and unexpected prices remain. He says that's especially high among high-income consumers. And, Becky, there are other reports out, Bain & Company and others, pointing to upper-income consumers saying that their intention to spend is less going into the start of the year. A lot of them kind of perhaps spooked by the pullback in the market at the end of last year. This is a significant headwind, though, perhaps for the year ahead, because if the upper income consumers are spending less and discretionary spending is down, that could have impacts more broadly.
It's just that it's counter to what we've heard from a lot of the big banks that have reported earnings in the last week or so. They say that Americans are still kind of very strong, especially what we heard in the fourth quarter as we headed into the holiday season. The end of December, beginning of January were pretty strong for some of those things. I guess there are hidden costs, like the insurance costs you mentioned, that are popping up that are catching people too.
I think things are catching people by surprise, and these kind of income-adjusted prices, where the more that you earn, the more that you're spending, the more that other ancillary expenses are adding to those delinquency rates, and that's what VantageScore says they have been seeing. The other thing, some other cautionary flags that people should be paying attention to is now credit reporting agencies are getting the information about federal student loan payments that have not been paid.
Right.
And so that could have a significant impact on credit scores. Tavares says as much as an 80-point drop in what we've seen in credit scores because those loans.
Under the last administration, people thought they were going to be forgiven. They're not going to be.
And they're not going to be, probably. Exactly. And then also the wildfires. So that $40 billion in insured losses, those insurance rates going up, that's something else that could impact delinquency rates for high-income consumers in particular.
Sharon, thank you.
Sure.